This is such a predicament of Cirrus research. The latest issue of the Signals report is just out. This report tends to look at stocks versus bonds, large versus small, growth versus value, and so on. The title of this report for the month is Allocation Model Triggers Sizable Equity Overweight. And I thought I'd go into that just because in this moment, there are enough conflicting signals that we're all seeing, I think. So let me try to explain this. The allocation model here is basically a measure of various characters that sort of rank order stocks versus bonds. And this rating, basically, when you convert it, it leads to a 73% allocation to equities. If the long-term allocation number is around let's say a 49%, this is sizably overweight. And I want to bring that in context of what we've just gone through, given the way the market has sold down in the last year. How could we have the courage to race right back into equities? A couple of things are going on here. One, fundamentals have adjusted quite a bit. In other words, in our full quarterly outlook, we walk through elements such as earnings expectations adjusting sharply, such as the credit market stabilizing even though spreads are wider. So a number of elements I think are underway. The fact that the Fed is probably much further along where they were versus a year ago is also very important here. The other point, though, to bear in mind is that to some degree, this reading basically says that stocks outperforms bonds. It doesn't necessarily mean that we're off to the races. In fact, much of our work suggests it's still a tempered absolute return market, and we can be in a world where equities remain favored. So take a look at it. Some of the drivers of the model, just to get underneath a little bit, credit spreads, vol-adjusted credit spreads are stable to attractive. In addition to that, you've got yield spreads between equities and bonds that are telling you that maybe equities are still attractive. So a number of things that are going on here. Of course, the shock would be if you got more of an inflationary move. The question is, do bonds sell down harder than stocks? So I think we're still stuck in this moment. In addition to that, some of the work and the key indicators on style, growth versus value, that's also now lingering in sort of a neutral, marginally favoring growth. This is important because it's very counterintuitive. The idea is that if you can make a case that quality matters and the profit cycle is slowing, why isn't growth a super overweight? And I think a lot of that has to do with the work we've been doing on the IMEs, industrial materials, energy. Some of those grittier sectors matter. The top line growth for those groups are still accelerating. So to some degree, we understand why the style indicator is more neutral in a period where it should have been wholeheartedly growth. Take a look. And then finally, one very constructive reading is polarization, market crowding. That has been always a problem in the most speculative markets. It was no exception in this past dramatic move in the pandemic world. However, something that's super interesting is that the leadership baskets have been really redefined in the last 12, 18 months. Much quicker for the small cap market, but in the left pie chart, what you're looking at is the top basket of leadership stocks. And you'll notice that it's significantly diverse versus where it was, let's say, 2 years ago, where over 50% of the weighting was tech and healthcare. So I do think leadership has rotated. I think we're in a healthier footing than we were just 6 months ago. Take a look at the report. Always happy to take your questions. Thank you.